Good day, everyone. Welcome back. I'm Ruben Torrens, and today I'd like to tell you about the big picture of retirement income. And why the big picture? Well, your retirement income is composed of a lot of stuff. So first you have government pensions, then you add to that government pensions your own effort, your own savings, probably in RRSPs. Most people save in RRSPs for their retirement. You may have also the locked-in retirement account or an employer pension, which is basically the same thing, that will be transferred to a LIF, to a life income fund at retirement, or transferred to an annuity. And then you don't need to forget about your income tax because if you're retired, you continue to pay income tax, but in a different way. You have more tax credits, so you want to make use of those tax credits to keep your tax man on a leash. And then finally, you need to plan what is going to be in your estate for your final income tax return. And the executor of your will need to file the final income tax. And if you get to that point of life or to the end of life with lots of registered savings, such as a RIF or LIF, and this will be inherited by your children, then, well, you can have a problem because the tax man is going to have a huge share of it. So you can plan to withdraw uh, your retirement savings by your estimated life expectancy, and only you can estimate your own life expectancy based on the longevity of your parents and your family. So all this can add to a lot of confusion. So let's get on this item by item and try to solve the confusion. If I fail at this, I'm going to increase your confusion at the most. Okay, let's talk about government pensions. So government pensions are essential for most Canadians. Like government pensions are at the very least 50% of the retirement income of most Canadians. So this is 50% of income of anybody is so important. This is why you need to look at government pensions. And you want to take your CPP, want to take your OAS, and if you will qualify or not, if you will be eligible to receive guaranteed income supplement. Because most advisors, and this is what I found, thanks to you guys, because you guys have been calling me and sending me messages and becoming my clients for retirement, but I need to know to find out more because you're not my client on investments. So, thanks to you guys, I just find out that most financial advisors are totally against the guaranteed income supplement and recommend people not to think about it because it's nothing and they won't qualify. And they were telling me a couple that I spoke to recently, they were telling me this, and because they do not have 40 years of Canadian residency, so they will qualify together for $998 each per month of guaranteed income supplement. So I don't think that's a small amount. So there is a lot of resistance on the guaranteed income supplement, and there is a lot of misleading information about it. So you have to be very, very careful. By the way, you can subscribe to my channel and make sure that you're not going to miss future videos because I always talk about this topic and I always give the exact information that you need, everything you need to know in order to maximize your government pensions. So we'll go to RRSPs. RRSP, most people save in RRSPs, but RRSPs, one day they will have to be merged or combined or synchronized with your government pensions ultimately. This is why it's so important. You can go to www.pensionbooster.ca, which is my website, and look at the calculators and enter, even if you are 35, 40, 45 years old and you're saving for your retirement, enter your Canada Pension Plan information, figure out your Canada Pension Plan. Watch my videos and you will learn how to figure out your Canada Pension Plan. Enter that data and see how much guaranteed income supplement you would qualify for at retirement. So, and then just figure out how much RRSPs you will be saving, and that will tell you if you're saving RRSPs or not. So RRSPs, they're tricky because they're taxable every time. You have to be careful. They're not only taxable, but can reduce your guaranteed income supplement. And if you have a lot of income at retirement, such as an individual, personal income, around $80,000, and you withdraw RRSPs, well, you will pay a high tax rate in the province of Ontario, for example, around 32%, plus another 15% for the old age security clawback. You got to watch at that too, because your tax rate can go through the ceiling. I have at my office a lot of people retiring, teachers and police officers, and people have had high pensions, saying the government is killing me with the deductions, with the taxes that I'm paying on my RRSPs. Exactly, but there is nothing to do now. You need to plan this way ahead of time to make sure that ain't going to happen. Okay, so watch out with that. LIRA to leave. LIRA is a long-term retirement account. That is when you are working at an employer that offers a pension, and you leave that employer or you retire and you don't want to trigger your pension into income, you move it into a LIRA, certain types of pension, not all pensions. And then once you want to convert that into an income stream at retirement, so you move into a LIF, into a life income fund. Not much that you can do about it, because other than waiting until age 71, because this is the an employer pension. If you work for the employer, you have the pension. And the LIRA or the RRSP can be turned into an annuity as well. Mind you, I'm not a fan of annuities. Today for today, they're good because interest rates are high, but but in annuities, you lose control of your money, total control, right? Basically, literally, what you're saying, what you're doing is selling your money. And but this, the RRSPs, the lead and the annuities, is what your financial advisor handles very, very well, because this is what they're trained for. Government pensions are another topic for most advisors. RRSP, LIDA, and annuity, this is your advisor territory. And then some advisors, advanced advisors, may dip into income tax, into the type of income tax that you will pay at retirement, balancing out with tax credits, making sure that you're not going to lose tax credits, or you try not to lose tax credits, depending how much money you save, and uh, and also balancing out with the final income tax. Whatever life expectancy you are estimating, you think that your parents live up to age 95, and you will live up to age 95. So then by age from 90 to 95, 96, 97, you want your registered accounts such as RIF or LIF to end. So if you need to withdraw more, a little more every year, you should move into a TFSA or to an open account. But what happens is, if you pass away with a large amount of money into your registered accounts, so there is going to be a large tax bill on your children or on the beneficiaries of your will. So, and this is how the whole thing works. These are the things that you need to discuss with your financial advisor. If you need more information, you can always contact me at my email address, and I offer 30 minutes of free consultation. I hope I didn't add more to the confusion. I hope I clarified a couple of things. I would say thank you for watching, and I hope to see you soon on my next video.